So this kind of tax policy is going to backfire. So the budget deficits are going to get bigger. All they're going to do is run and raise taxes on the rich, which is just going to backfire. No one's going to talk about raising taxes on the middle class. So whether they're going to create inflation. Now, inflation is a tax that hits the middle class and the poor, but they'll never admit that it's a tax. Right? They're just going to keep on creating inflation and lying about it. But we're going to have this crisis. And the bubble that's going to burst during the Obama second term is going to be the bond market bubble and the currency bubble, or I call it in my book, the real crash, the government bubble. Because that's really what it is. If you look at where all the cheap money went to, in the 1990s, the money went into the stock market. In the next decade, it went into housing. It's now going into government. I mean, the U.S. government is enormous. It's spending almost $4 trillion. In fact, next budget might be the first $4 trillion budget. So the government is more than doubled in size where it was 10 years ago. I mean, the United States GDP didn't double, our population didn't double, but the government is twice as big. And we're paying for it with debt. And despite the fact that our debt is the highest it's ever been, our interest rates are as low as they've ever been. I mean, you can imagine that. I mean, we are as uncreditworthy as we've ever been, yet we're borrowing at the lowest rates in history, which makes no sense. It should be the opposite. So you know this is a gigantic bubble. And when this bubble bursts, the consequences are far greater than when the housing bubble bursts or the stock market bubble. Because not only is the economy more exposed to this government bubble and the bond bubble, but when this bubble bursts, there are no bailouts. Right? I mean, the U.S. government was able to bail out the economy from the housing bubble because it was able to go deeper into debt to do it. And we transferred a lot of the private sector debt to the public. But when the government is in trouble, there are no bailouts. See, that's what happened in Ireland. The Irish government bailed out their banks, and then the Irish government was broke. Now, they were able to get a bailout from Europe. They're part of the Eurozone. But Europe's not going to bail out America. You know, who's going to bail out the U.S. government? There's nobody big enough. Right? There's that expression, you know, too big to fail. Well, America is too big to bail. It's impossible, especially since the world has already been bailing us out. Think about all the money we've already borrowed from Japan, from China, from Saudi Arabia. I mean, we owe money to everybody. I mean, that's, you know, we don't discriminate in that respect. We got a trade deficit with everybody. We borrow from everybody. We owe everybody. And we can't pay anybody. All we can do, right, is keep borrowing money from the same people who loaned it to us in the first place. And this is going to get exposed in the next few years. I mean, I don't know if what's going on in Japan is going to buy us time or shorten the fuse. Because to me, I'm thinking if the Japanese, you know, the yen just dropped 10, 15% in a very short period of time. And if that weakness in the yen and the anticipation of future weakness in the yen causes a big spike in consumer prices in Japan, which it very easily could. And it's not like consumer prices are collapsing in Japan. I mean, they've been pretty stable, despite the fact that they print a lot of yen, because the yen has been a relatively strong currency. But in the last couple of months, it's fallen off a cliff. And the Japanese import a lot of raw materials. They import all their oil. So oil prices just really shot up for the Japanese. And if all of a sudden you get a big increase in consumer prices, what are they going to do? Even if they raise their inflation target from 1% to 2%, what if inflation goes to 3 or 4%? Now they're above the target. Are they going to tighten? Imagine that. What's going to happen to the JGB market if they have to start tightening? Because now all of a sudden they got more inflation than they bargained for. And the whole thing is crazy. And if you want to read some of the stupidest economics out there now, read some of these articles about Japan. Because they think that all they need is to create inflation in Japan, and it's going to be great. I read this article this one guy wrote, and he's talking about how Japan, it's a Bloomberg story, how Japan has been suffering from deflation. As if you suffer because prices are going down. I mean, consumers benefit when prices are going down. In fact, another article I read referenced a survey that was done by the Bank of Japan. And according to this survey, 75% of the Japanese were upset when prices went up. And I forget the percentage, but a significant percentage of Japanese said that they like it when prices go down. What are they, idiots? Of course they like it when everybody likes it when prices go down. So they're basically saying that they don't realize that they need prices to go up. That they like prices going down, but they need higher prices because that's how you get economic growth, is that you force prices. And this one article said that the Japanese economy is suffering because of a persistent deflation. And according to this article, consumer prices were dropping by about 1% per year. And according to this, the author of the article, because of that, Japanese consumers weren't spending. They weren't spending. They were waiting to save that 1%. I would think, can you imagine, so there's somebody in Japan who wants something, who needs something, but I say, God, I really need a new car, but I'm going to wait another year because I can get it 1% cheaper. 1%! I mean, does nobody in Japan have a cell phone? Because, I mean, they fall by a lot more than that. Or has no one in Japan bought a computer or a television set? No, in fact, the Japanese buy more branded luxury goods than anybody else in the world. They're not waiting for prices to drop by 1%. There's utility. I mean, you want to have something now. So it's like, gee, I'm really hungry. Well, I'm going to wait because I can get my food. If I wait a week, I can eat. It'll be cheaper. No, you want something right away. In fact, it's falling prices that create demand. But so this guy Abe that was just elected says that he wants to create inflation to cause incomes to go up so Japanese will spend more. Well, just on the anticipation of that, Japanese incomes have now lost 10 or 15% of their purchasing power. Now they're going to have to pay more money for everything they want to buy. But what I'm interested in or concerned about or thinking about is if all of a sudden this psychology of, oh no, now there's going to be inflation in Japan, prices are going to start to rise, the Japanese citizens are going to they're not going to want to spend necessarily, but they're going to want to sell their bonds, they're going to want to buy other assets, they're going to buy gold, they're going to buy foreign stocks or something to hedge against inflation. They might even buy Japanese stocks. Look at the Japanese stock market. It's gone straight up ever since they started to create inflation. Well, that's going to prick the Japanese bond bubble. And the Japanese are talking about buying more treasuries to weaken the yen. Well, they don't have to. The yen is weakening all by itself. You see, when the yen was strengthening, they could afford to buy treasuries. It was stupid, but they were slowing down the rate of increase of the yen by intervening, and they were, building up their foreign exchange reserves. But if the yen starts to fall, they don't have any extra reserves. In fact, they have to start buying JGBs to prevent that bubble from collapsing. I don't think they can simultaneously support two bond bubbles, one in America and one in Japan. Also, we talk about sovereign, their sovereign wealth, because they're thinking about, adding another $1 trillion to their reserves. They show you how crazy it is. There was this guy that was on CNBC. He was an economics professor from an American university, and it shows you why you shouldn't study economics at an American university. But I kid you not, this guy was on CNBC, and he was there to talk about the fact that he believed that America should also have a sovereign wealth fund, to create a sovereign wealth fund. And I'm thinking, doesn't this guy understand that in order to have a sovereign wealth fund, you have to have sovereign wealth? And because the reason that Japan and China and all these other countries have sovereign wealth funds is because they have huge surpluses with America. And they earn all these dollars, and their citizens have nothing to spend them on. So the central banks accumulate them to stop their currencies from rising. And because they have so many treasuries, they wanted to diversify. So they created sovereign wealth funds to sell some of their treasuries. Well, we're already selling treasuries. That's all we do is sell treasuries. We have sovereign liabilities. We don't have any wealth. And in fact, one of the people on CNBC, one of the hosts, actually said, "Well, wait a minute. Those countries have surpluses. We have a deficit, right? And he said, "Well, that doesn't matter. We'll just borrow the money for our sovereign wealth fund." Interest rates are really low, so we're supposed to leverage up, and we're supposed to start a leveraged sovereign wealth fund. Well, what happens when they buy stuff like Solyndra in there and it goes down? We have a margin call on our sovereign wealth fund. The whole thing was nonsense. I mean, these countries shouldn't even have sovereign wealth funds. They're doing their citizens a disservice by accumulating these surpluses. But how can America have a sovereign wealth? We're going to borrow money more money from Japan and China to have our sovereign wealth fund? And of course he said, well, you just take advantage of interest rates while they're low. In fact, the main argument in favor of the U.S. borrowing more money is because interest rates are so low. Yeah, but you have to pay it back, and rates are going to go up. It's like if somebody says, they're giving away free heroin. Okay, well then should you take it because the heroin is free? Sometimes, you have to turn it down. Just because it's cheap doesn't mean you should do it. But everybody wants to take advantage of the fact that interest rates are low because they're low now. But when interest rates go up, it's a whole different story. And that's where we're headed. And I'm going to take questions. So I think during the next few years, whether it's Japan that ends up pricking our bubble or it just bursts on its own, the dollar, I think, is going to force the Fed's hands. The situation in Europe temporarily improves. I don't think long-term they solve their problems. They haven't. But once the euro starts to go up, that takes a lot of pressure off the eurozone because now money is going into the euro. It's not leaving the euro. It's going to bring rates down there, and it's going to buy them some time. And then as that starts to happen, as the risk assets, at least they call them risk assets, starts to go up, that puts pressure on the dollar. And as the dollar starts to fall, it's going to feed through to commodity prices, consumer prices, and eventually, the world starts to realize that U.S. inflation is too high. The Fed continues to do nothing. They continue to keep interest rates at zero. That weakens the dollar even further. Eventually, people realize that the Fed is all bark. It's no bite when it comes to fighting inflation. They realize they have no exit strategy. And then an orderly decline in the dollar turns into a rout. And the dollar really starts to tank. And then that's the end of the game. Because then we have to really choose. Right? We have to pick our poison. How do we want to die? Do we want to die through deflation or hyperinflation? But those are the only two choices. There's no in between. Either we're going to save the currency and collapse this bubble economy and just let the banks fail, let real estate tank, let the government restructure the debt. A legitimate restructuring. Legitimately, just like Greece. Greece gave everybody a haircut. They look, we can't pay 50 cents on the dollar, whatever it was. America has to do the same thing. Because it is impossible for America to pay back its bills. It has borrowed way more than we have capacity to pay. The American public, I think was it 40% of the Americans have less than $500 saved. We have nothing. How can we pay, the per capita debt is something like $50,000, $60,000 a person. There's no way, and that's just the 16.5 trillion. The actual debt, the numbers are bigger, but just to pay the bonds. So it is impossible. We don't have the capacity to pay back the debt. We can service it. We can pay the interest only, as long as interest rates are at zero. But if interest rates go up, we don't even have the ability to make the interest payments, let alone to retire the principal. So we have to come to terms with that. And I think it's better to honestly default and pay 20 cents on the dollar, 30 cents on the dollar, than to inflate. But those are the choices. Either we default or we destroy the currency. And that has even more profound consequences for the U.S. But for the global economy, a lot of things are going to change. Because right now, the global economy is organized around the dollar as the reserve currency. Everybody is trying to compete to sell products to 300 million Americans that can't afford to buy them. But everybody wants to lend us money because we'll keep shopping even though we're broke. And everybody wants to pretend that they have earnings because, but they're not real earnings. We went through something similar to this in the U.S. on a smaller scale. Back in the dot-com days, there were a lot of companies, a lot of telecom companies. I remember Nortel here in Canada, but there are a lot of companies that were selling a lot of equipment to the dot-coms. But the dot-coms didn't have any money because they didn't earn any money. So they were buying on credit. And so these companies like Cisco or Lucent, were booking all these earnings because they were selling, products to companies, but they weren't getting paid. They got IOUs, but they counted them as earnings. But when all these companies went bankrupt, they had to write down all these earnings because they never really earned it. So that's really what's going on, this global vendor financing. You have all these countries that are selling their products to America in exchange for IOUs that are basically worthless, because we don't have the industrial capacity to export the goods to pay off these IOUs. Because again, people aren't exporting to America to earn little pieces of paper. They want real stuff, and the paper represents an IOU for stuff. But ultimately, if we can't produce enough because we don't have the capacity, then so this whole restructuring is going to happen. But I think ultimately it's going to be a good thing for the global economy once the U.S. implodes. I think the big problem for the global economy is propping up America. I think the cost of propping up America, it exerts a tremendous burden on the world. It's very expensive to keep Americans living the standard that we've grown accustomed to. We're an expensive habit. And I think if the world can break itself of that habit, then there's going to be a lot more resources, a lot more consumer goods for everybody else. And then Americans are, the ride on the global gravy train is going to come to an end. Americans are going to have to start producing like everybody else. We're not going to be able to print money to pay for our imports. We're going to have to make stuff. We're going to have real jobs and actually, make things and not just pretend to work, which unfortunately is what a lot of Americans do. But I think that's going to set up a lot of opportunities. I think if you're an investor, you have to understand what the world is going to look like, right? You invest for what the future is going to be, not what the past was. So you have to understand the dynamics, how this is going to change, how currency values are going to realign, how living standards are going to change. And if you know where the wealth is going to go, you can get there ahead of it. You can position your portfolio. You can own the stocks that will benefit from this transition. There's going to be a winner and a loser. When the dollar goes down, it doesn't go down in a vacuum. If you're talking about exchange rates, when a currency goes down, it's relative to some other currency. So whatever purchasing power Americans lose, somebody else is going to gain. The world is still going to produce stuff. The factories are still going to be there. Goods are still going to be produced. The question is who consumes them? Who gets them? And so you want to be positioned, you want to own the companies. And you also have to understand that, Americans, Americans have a lot of stuff. So the things that Americans buy are going to be different than the things that the Chinese buy. And, and think about, when an American buys a car, he's got a car. He's trading it in. He's got, it's not, so the utility is not that big. You just have a nicer car. But, in China, if a guy's buying a car, chances are it's the first car he's ever owned. He doesn't have a car to trade in. So number one, you don't have the raw material to recycle. You need new steel to build that car. But, it's a huge difference because you're going from a bicycle to a car, or you're going from nothing. And, and when the Chinese are going to buy, when they buy a refrigerator, they buy, a dishwasher. This is the first one. So there's a lot of raw material, a lot of natural resources are going to be consumed. So, things are going to change, globally and the type of things. So the whole investment landscape, and I think most people are looking in the rearview mirror. They see America and they think things are going to stay the way they are. Just like they looked at the housing market in 2006 and thought it was going to stay that way, and housing prices were going to keep on going. It's not. The global economy is going to change in a very profound way. And I think we're on the cusp of that. And from an investor, you have to understand that. And then if you own the right assets, you own the right stocks, in the right countries, in the right currencies, you can do really well. Unfortunately, I think a lot of people are going to get wiped out because they're going to be positioned in the completely wrong way. In fact, I think the people who unfortunately are going to lose the most are the people who think they're playing it the safest. You have people who are loaded up on sovereign debt, on U.S. treasuries, CDs, government municipal bonds. They're going to get wiped out. They think what they have is safe. They own, an asset. They say that the U.S. treasuries are risk-free return. They got it backwards. They're return-free risk. And people are going to wake up one morning and realize, that their whole life savings has evaporated because it's been spent by the government buying votes. Anyway, let me take some questions because I've been talking for a while.
Sure. And Peter, just a reminder, you've got some comment cards. You can turn those in to advisors at the doorway. There's going to be a raffle for autographed copies of Peter's latest book.
Oh, are these my questions?
No, that is not a question from our presentation. But we do have some legitimate questions. So the first one, Peter, is what can we do to protect Canada from a U.S. crash?
Well, first thing you have to do is not, follow our monetary mistakes. If you remember, your mother probably used to tell you, hey, if your friend jumped over a bridge, would you do it too? Right? And you said, of course, no, I wouldn't. But, so we all learned that lesson, but apparently, governments and central bankers don't. Because, if your friend jumps over a bridge, that's exactly what you do. So if we want to debase our currency, well then every other central bank does the exact same thing, right? It's a race to debase. So in Canada, the Canadian government has short-term interest rates almost as low as ours. They're not quite zero, but they might as well be, right? But your 50 basis points is at the short-term rate. That's obviously too low. But the reason that Canada doesn't raise rates back to a more appropriate level, the main reason is because the Canadian dollar would rise. And that's foolhardy policy, but it's the same thing the Swiss did. It's, everybody is afraid of their currency going up. The Chinese are afraid of their currency going up. So the most important thing that Canada can do is not worry about, let the currency go up. It's a good thing. It means you're richer. It means that you have a higher standard of living. It means that your savings are more valuable. Your wages are more valuable. Prices come down. I mean, it's a good thing when your currency is going up. And I think if they can do that, then it will, the economy will be less vulnerable, trying to maintain a relationship where you sell products to a customer that can't afford to pay them. And realize that, look, when the Chinese rise up, and they will, and they let the RMB rise, and it's at like a 19-year high now against the dollar, but it will go a lot higher. There are 1 billion people in China, trade with them. And they actually make stuff that the Canadians want. So if you're going to sell resources, if you're going to sell oil, you want to sell it for stuff, not for treasuries. I think that the United States did Canada a favor by turning down the Keystone Pipeline, because you'd invested all this money to bring oil down to America, and we don't have any money to pay. Probably makes more sense to try to find a way to ship the oil to China, because they can afford it. And they're going to need a lot more of it when the Chinese let the currency go up, because now they're going to be able to have a lot more cars, and they're going to use a lot more energy. Americans, we're not going to need that much oil because we're not going to be able to afford it. We're going to be riding those Chinese bicycles.
So we have another question here, Peter. You talked about the U.S. should honestly default, but we have a question here. Will we see hyperinflation? I think you've got an interesting take.
Well, if we don't default, we will, because those are the choices. And the reason I think it would get out of hand is, it's kind of like, you can't get a little bit pregnant. You're pregnant or you're not. And so once you go down this monetary route, I don't think any country that had hyperinflation set out, it wasn't a policy goal. It wasn't like, what do you think we should do here? How about hyperinflation? It's just, that's what happens. Once you go down, you can't stop. Once you start moving in that direction. Because if the government is going to try, to try to keep interest rates down, they have to print more and more money to do it. But the minute they do that, they debase the value of the currency, and therefore they make the value of whatever debt instrument they're buying even less valuable, so now more people want to sell. And now, the Federal Reserve has to start monetizing mortgage, state bonds, because if interest rates go up, California defaults. Well, they get let California default. So now they have to start buying California muni bonds. Well, but then if interest rates go up, a lot of our corporations are going to fail. So now they have to start buying corporate. The Fed has to start monetizing everything. But then once you see this, once any private creditor realizes nobody is going to buy a bond that yields 3%, 4%, 5%, if inflation is 10% or 15%, the only one that's dumb enough to do that is the Fed, because it costs them nothing. So then if nobody will buy any US dollar denominated bonds, if the only buyer is the Fed, if they're not the buyer of last resort, they're the only buyer, the dollar just implodes. Nobody will take it. Nobody will transact in it. So at some point, you have to let interest rates go up to where they need to be. And if inflation gets to 10%, 15% before the Fed raises rates, where are they going to raise rates to? They got to raise them above the inflation rate. Because as long as interest rates are negative, you still have a problem. So if inflation is 10%, you got to make rates 12%, 13% in order to stop it. Volcker had to bring interest rates up to 20% in 1980. Well, what would 20% interest rates look like today in America? I mean, you can't even imagine. I mean, what if the national debt is $20 trillion and interest rates are at 20%? That's $4 trillion in interest payments. We can't make $4 trillion in interest payments. And if interest rates were 20%, the government would be lucky to collect $1 trillion in taxes. So, I mean, the numbers are so enormous that the only solution would involve a default. And I think that's a good thing. Because also, think about this, the only way we can avoid a default would be to basically eliminate Social Security, eliminate, Medicare, and politically, there is no way that a U.S. politician is going to say, hey, we got to cut Social Security because we have a big interest payment coming to the Chinese. We borrow money and we're good for it, so, we got to cut your Social Security so we can pay the Chinese. The Chinese can't vote in our elections. The Japanese, why are we going to pay non-voters ahead of voters? But I think if we're going to have a realistic solution, it has to mean everybody sacrifices who is going to be paid. And when I talk about sacrifice doesn't mean a tax hike for somebody, because they're already sacrificing. When you're talking about sacrifice with a budget, it's anybody who's been promised a check from the government gets a smaller check. Everybody. Bondholders, pensioners, current government employees, anybody who's been promised something for the government is going to have to get something less than they were promised. Some people are going to get nothing. But that's what has to happen. But I think it would be impossible politically to ask Americans to sacrifice their Social Security benefits or their Medicare benefits, but make the bondholders whole. Why? Why should the bondholders? I mean, after all, look, it takes two to tango. I mean, anybody who loans money to America deserves to lose. If you're that stupid, if you're going to, like the people who bought Greek government bonds deserve to lose money. They should have known that the Greeks weren't good for their debt. So anybody dumb enough to buy a U.S. Treasury deserves to lose. So they're going to, but no, should we pay zero? No. You got to work out something, right? Work out a reasonable restructuring. Now, I know that there are some people that think, look, we'll just create some inflation, and we'll gradually inflate our way out of this debt. We'll just create inflation. The dollar will lose maybe half its value over the next 10 or 15 years, and somehow the GDP is going to grow, and the debt will shrink relative to GDP because of inflation. It's not going to work out that way. The economy is too screwed up because of our imbalances. The trade deficits keep getting bigger. We're not going to be able to inflate our way into an orderly, decline of the debt. It's not going to happen. Just like they think if we just create inflation, that's how they think that they're going to make wages go up. They're not going to go up. There's no jobs. So wages aren't going up, and people think that we can't have inflation. They'll say, look, there's no inflation because wages aren't going up. Yeah, it's worse when wages aren't going up, because then the only thing that's going up are prices, but the price of labor doesn't go up. So everything you want to buy gets more expensive, but you don't have any more money to pay for it. And somehow the politicians tell us this is a good thing. But the economy is so screwed up structurally that we can't raise incomes. We can just raise goods prices, but people aren't going to get higher wages from all the inflation. So it's not real economic growth, so it's not going to work. And then the other problem is we don't have long-term debt. People forget that the debt is all short maturities. And so high interest, high inflation, the minute it's perceived, that causes a big increase in interest rates that you can't finance. The only way inflation works, first you've got to sucker everybody into buying 30-year bonds, right? And then you have a bunch of inflation after they're locked in. But if your creditors have T-bills, once they figure out there's inflation, they're not going to keep rolling over their debt at 1% when inflation is 5 or 10%. So it's not going to work. Eventually it's just going to implode. And every bubble bursts violently. They always think they can engineer some kind of soft landing. You know, they thought that we'd have a soft landing from the housing market coming down. And I said back then that it's impossible. You can go back and look at my mortgage banker speech on YouTube from 2006. But it never works. The governments always think that they can cover up their tracks with inflation. But it doesn't work. And so it's going to either be hyperinflation or we're going to have to default. It's one or the other. Default is better. Restructuring is better. But that means that politicians have to admit their mistakes. They have to fess up and come clean. Just like, you know, Lance Armstrong finally, now he's coming clean, right? I mean, everybody's figured out, so I guess he figures you might as well tell the truth now. So our politicians eventually have to tell the truth. And if they don't, if they try to push it till the very, very end, then we destroy the currency. And that's the worst possible outcome, because that's where you have real chaos. I mean, that's where you have civil unrest. That's where you lay a foundation for real tyranny. Who knows what kind of government can emerge in that kind of chaos? And you know that they're going to try to blame it on capitalism, and just, use it as an excuse to go all in on socialism, to just kind of totally remake America. And then we can officially be, a banana republic, and we're going to be like your Mexico. You guys are going to have to, but I think everything is, if you let the Americans in though, let us come in, we're, the ones that come in there are the ones that want to work,
So, Peter, we have a number of questions on Canada and how Canada factors in and all this. There's a specific question, so I'll lead with that, which is, what will be the effect of the collapse of U.S. bonds on Canada?
Well, I mean, if you own U.S. bonds, it's not going to be good for you. But, look, I think that the U.S. dollar collapsing is a good thing for the world as long as the world lets it collapse. If the world tries to stop it, it's very expensive for the world because the world has to keep diverting resources to America. But I think that Canadians are in a very good position to benefit from a collapse of the dollar because there's a lot of stuff that you can buy that's pretty close. You don't have to, you don't have to have it shipped across the Atlantic or the Pacific. You could just drive a U-Haul down south of the border. Because there's going to be a lot of Americans having yard sales and all kinds of things. Used cars are going to be for sale. We're going to have to sell everything we have just to eat, just to pay for energy. And of course, the weather up parts of Canada gets pretty cold. There's going to be a lot of condos down in Florida that you guys can buy really, really cheap. So I think it pays, to be close to the world's bargain basement, Go across the border, you can buy all kinds of stuff for next to nothing. And you'll also be able to pick up nice assets. Besides real estate, maybe U.S. companies will be on sale. As long as the government doesn't try to react and think, oh, it's a problem that the dollar is going down, that the U.S. dollar is going down, the Canadian dollar is going up. And if the rest of the world, as I said, if you think about, if you had, an in-law that moved in with you, and just, didn't have a job, and just, ate all your food and hogged, the remote control, and just wouldn't leave, that's us. But, if you finally kick them out, you have more food to eat yourself, you can watch what you want. So I think when you don't have to support America, it's going to be a good thing. And of course, if it's shocks therapy, it would be great if America could add to the world's output, if we could be a positive force in the economy, if we could start producing again instead of freeloading, which is really what we do. We have a trade deficit that is $50 billion a month, $600 billion a year. That means the world has to loan us $600 billion a year. What would the world be doing with that money if they didn't loan it to us? They could use it for themselves. They can consume it, or they can invest it productively in their own economies. Instead, they squander it on treasuries so we can live a lifestyle that in many cases is higher than the people who are loaning us the money. We borrow from the poorest people in the world, Americans. And, so when this changes, everybody is going to be better off. But, there's going to be some winners and losers, of course. If you're a Canadian business and your customers are American, let's say you make American flags. You sell them in America. All right, well, you're going to have to make some some other flags, you know. Well, and if you can't make, you know, if you can't figure out other kind of flags to make, well, then you're going to go out of business. But that's fine, because somebody in Canada will buy your plant, hire your workers, and do something else. I mean, you know, that's what a market does. You reallocate resources and use them effectively, and somebody goes bankrupt, and now because they don't know how to use the resources, and that allows somebody else to pick them up and make better use of them. So as long as the government stays out and lets things change. But I do think that one of the big benefits, I think, from Canada is Canada has a tremendous supply of natural resources, which I think are going to be in demand. And I think if Canada can simply, you know, and it's easier said than done, but I can imagine how wealthy Canada would be. I mean, how incredibly wealthy if Canada could simply, you know, limit government even more. I mean, imagine if you can take the government of Hong Kong and have it in Canada or Singapore, because these are countries that have enormous standard of living with no resources at all, nothing. The only thing they have is freedom. But if you can combine freedom with natural resources, I mean, this place, you know, it'd be like another planet. Canada has so much going for it. But it's hard, you know. When you have a democracy, you know, socialism is very seductive to the masses. People always want to vote for something for nothing, and not enough people have confidence in the free market. They don't understand how it works. They don't understand that, you know, that if you don't have all these government programs, if you get rid of all this, you don't have, you know, all these wage laws, and that people will be better off. But to the extent that Canada can somehow, you know, undo a lot of the social welfare state and get rid of a lot of these government supports and have more freedom, then it could be a huge boom for Canada.
Okay, we have a lot of questions, more than we can get to. I'll just remind we have advisors that can answer some of these, and some of them are probably for Peter alone, but we can't get to all of them. Peter, we've got a lot on the BRIC countries, which you partially addressed there, but maybe you could talk a bit about that and just address kind of your view on gold as a safe haven and as an asset class. Just specifically talk to those two things, maybe.
Well, I mean, gold is going to do extremely well in a environment of, you know, currency upheaval. You know, we get a crash in the dollar. Dollar's a reserve currency, so if the dollar goes, I mean, you know, gold's going to do extremely well. People are going to recognize that they need gold. And in fact, look, you've seen that, you know, Germany is bringing its gold home. The Dutch have asked for their gold. In fact, the interesting thing about Germany is Germany asked for a third of its gold. And we told them, okay, but it's going to take us 7 years to give it to you. Now, I don't know, I mean, supposedly we have all this gold. I mean, what Germany is asking for is a tiny percentage of what we theoretically have. Why is it going to take us 7 years to deliver it? You try to figure that out. But, you know, the BRIC economies in particular, they're the ones that need to buy gold the most. I mean, you look at, you know, countries like Germany, I think something like 40 or 50% or maybe more of their reserves are gold. But countries like China or Brazil or India, 2 or 3% of their reserves are gold. And they have enormous reserves in foreign currencies, mostly dollars. But so they need to be big buyers of gold. And so I think that the move that we've seen in gold so far is nothing. Because you have to remember that when gold started this run at about 250, 260, it was at a ridiculously low price. So to say, well, gold's gone from 250 to 1600, I think that's a big move. It never should have been down at 250. So it moved from an artificially suppressed level because of supreme confidence in governments and central banks. And it was like the opposite of the dot-com boom and the gold bust happened simultaneously. So you had ultimate faith in central bankers, and therefore nobody wanted to own gold. So that's been changing. But if you look at the increase in the price of gold, it pretty much, just followed the increase in the cost of producing it. It's not like there's a lot more demand for gold. It's just more expensive to get out of the ground. I mean, so we haven't really seen a huge real increase because gold companies aren't making a lot of money. It's not like it's a boom in the mining industry. In fact, it's almost like a bust in the mining industry. So gold prices have barely begun to move. And in fact, I'm talking to institutional investors. I sit at tables and speak around, and nobody owns any gold. Nobody owns any gold stocks. I mean, the real money, I mean, you go to these conferences and you see a real biased sample, right? I mean, yeah, if you go to a conference like this, a resource conference, and yeah, we own gold. But I mean, this is a tiny percentage of the population. And if you look at the people that manage big pools of other people's money, the big pension funds, the endowments, they have no gold, none. They have no gold stocks. And so it's barely even begun. So at some point, you're going to really see a big move up in the price of gold. And people keep asking me, well, why isn't gold going up? Well, look, it has gone up. But why isn't it going up faster? Because people are stupid. People don't understand, why did real estate prices go up? Why did the dot-coms? I mean, the market doesn't get prices right. It gets them right in the long run, but assets are generally mispriced based on perception. If the majority of people think something, then it's priced based on the majority, what they think. But once people realize, the situation, how much inflation has been created while the governments have been lying about it, and how much more inflation is going to be created. And ultimately, because they've created so much, there's usually a lag, too, between creating inflation, printing money, and the effect on prices. And, too, there is some of it that's psychological. If people think, people are willing to hold on to their money, but once they realize that things are going to get expensive, people start to hoard. People start to buy things in advance. I mean, once people start to realize how much prices are going up, they're just going to buy stuff before they need it. Don't wait till you run out of cereal. Just buy a year's worth, because the price is going to go up. Why put cash in the bank earning 1% so you can buy stuff next year and it's 10 or 15% more expensive? Just buy it now. So people are going to start to turn over money quicker, and it's just going to go out of control. And so gold is going to just skyrocket, because that's a way that people can preserve their purchasing power. What if you don't want to fill up your pantries with cornflakes? Well, I want to buy gold, because then I can buy my food next year, and I'll pay for it with my gold, because the gold is going to go up faster than the cornflakes. But no one's going to hold on to dollars. And as far as the emerging markets, yeah, I mean, they're not all the same. I mean, there's a difference, but I really think the countries that where people are working hard, where they don't have a culture where people are looking for a handout. They're not looking to collect Social Security or some government pension. They're working to have high savings rates. Just look, go home and look at where all this stuff that you buy is made. That's where you want to invest.
Okay, so we probably have time for one more question. We'll make it a pretty specific question here. So, Peter, why do you still recommend foreign stocks when we have never seen a rally during a major catastrophic event?
Well, I don't know. There's a rally now, but if you want to just look at 2008 as your frame of reference, everything went down in 2008 because the dollar went up, and so 2008 was a flight to the dollar. But if we have a currency crisis where people are fleeing the dollar, then it's going to look very different. And yes, if we have an exact replica of 2008, then everything's going to go down again. But it's not likely that everything is going to be exactly the way it was. Is it possible? Sure. But of course, everything was unwound. The dollar had a big rally in 2008, but then it made new lows in 2010. I mean, it made record lows against the Swiss franc, it hit record lows against the yen, and it went the record lows against the Aussie dollar. I mean, so all those, the gains the dollar had reversed. But I think that the next crisis is a dollar crisis. And so by definition, it won't look anything like 2008. 2008 was, everybody ran towards the blast, which was kind of amazing. We had this crisis in the U.S. and people bought the dollar. But ultimately, when people want to get out of the dollar, then it's going to be a flight from paper, and people are going to buy real things. So I think ultimately the biggest losses are going to be the bondholders. See, the bondholders won in 2008. If you own treasuries, treasuries did really well in 2008. But But in the end, that's where the biggest losses are going to be, is going to be in paper. So if you think as a currency crisis, you've got to own real stuff. Now you can say, well, I'm going to only own gold. Well, gold went down in 2008 too, but of course it made a new high after the dust settled. But I think the next crisis will be different, and because I think a lot of people are expecting it now. A lot of people, again, look in the rearview mirror, and they expect the future to be exactly like the past. Oh, this is what happened before, so this is what's going to happen again. Well, the markets generally try to fool people. And so if you're expecting something, in many cases, the opposite happens. There's something that you're not expecting. And people look at the dollar and treasuries, and they think, oh, those are the riskless assets, the risk-free assets. You know, they say it's risk on. We're going to buy stocks. We're going to buy gold. Oh, and you want to take the risk off. You buy treasuries. I think they got it backwards. If the risk is a collapse of the dollar, then how can treasuries be safe? How can the dollar be safe? They're not. And so I think that we want to be positioned for that crisis. You know, a dollar crisis where everybody is trying to get rid of dollars, not accumulate dollars. And so then you have to own real things. And if you look at the values too on a lot of companies, a lot of stocks, a lot of these Asian markets, there are a lot of stocks that trade right now at 6 times earnings, 5 times earnings. I mean, there's low valuations. There are a lot of stocks that are trading at 9, 10, 11, 12% dividend yields. I mean, why wouldn't you want to buy these assets? Why wouldn't you want to collect these yields? I mean, people are sitting there piling into low-yielding treasuries, and they're bypassing higher-yielding real assets because they're afraid that the price might go down. Meanwhile, they're not worried that the intrinsic value of the paper, you know, which is worth nothing. There's no real. The government can just create it out of thin air. For a while, you know, we were talking about minting $1 trillion coin, and the world was like, "Oh, well, that'd be crazy." Well, how is that any crazier than what we're doing? At least $1 trillion coin might have an ounce of platinum in it. You can make $1 trillion bill. I mean, it doesn't have any of the paper is the same as a $1 bill. You know, but for some reason people would accept $1 trillion bill, but not $1 trillion coin. You know, but the idea was that's how easy it is. We create money out of thin air. Pretty soon you'll be using $1 trillion coins in vending machines to get a Coke or something.